Financial history notes with no small amount of irony that the first chairman of the SEC was a notorious stock speculator, Joseph P. Kennedy. Summoned to Washington by Franklin Delano Roosevelt to curb the very manipulations of which he had been accused, Kennedy used his understanding of market behavior that he had gained as a speculator and worked zealously to make the market safe for all participants. Over the next 60 years, many followed Kennedy's footsteps as chairman of the SEC, but few, if any, had his insight into the way of the markets and the investment industry that had grown up around them. That was until 1993, when Arthur Levitt Jr. was sworn in as the 25th commissioner of the SEC. Now, I must be careful to point out that, unlike his predecessor, Arthur's market insight was not the result of notorious speculation. Rather, it was the byproduct of a 27-year career on Wall Street that included his chairmanship of the Amex from 1978 to 1989 and his leadership at Shearson, now part of one of the firms poised to become a component of Citigroup. It was at the Amex that I got to know Arthur and worked under him for 4 years while the Amex built, among other things, the options market. I learned that if he were notorious for anything, it was for his leadership and his intelligence. He developed these with the knowledge of the way things really work on Wall Street. And he has since established 4 priorities at the SEC: improving investor protection, reforming the municipal debt markets, raising the standards of practice for brokers, and strengthening the prominence of U.S. capital markets the world over. During his term as chairman, the SEC has established the Office of Investor Education and has created one of the most popular sites on the World Wide Web through which the public receives corporate filings free of charge. Under Arthur's leadership, the SEC has worked to sever ties between the political campaign contributions and the municipal underwriting business. And the SEC has raised the industry's sales practice standards by attacking conflicts of interest in broker compensation. Armed with first-hand knowledge of the benefits of options, he has also been a force for eliminating the bureaucratic obstacles to introducing new products and implementing rule changes that thwarted the growth of the options market. Just a few weeks ago, Arthur was nominated by the President to serve a second 5-year term, the first chairman of the SEC in history selected to do so. I believe his effectiveness has everything to do with the respect that we have for what he knows. And agree or not, when Arthur speaks, we listen. Ladies and gentlemen, the chairman of the Securities Exchange Commission, Arthur Levitt.
Thank you very, very much, Bill. This is really a sentimental journey for me. So many of you interface with my past, and probably no one more than Leo Pomerantz. I wonder if he remembers going back about, more than 20 years ago when I was at a firm that was then called CBWL, and Leo tried to persuade me that we should be in the options business, and I was too dumb to listen. But we learn by our mistakes. This is a wonderful occasion. Every one of you are important participants in something which has made our markets the glory of the world, and I think it's time to take stock and to celebrate entrepreneurship and the enormous attainments that these institutions have created over the past 25 years. We've certainly come a long way since the CBOE opened up for business 25 years ago in a small and windowless room, the converted smoking lounge at the Chicago Board of Trade. I've always felt there's something about windowless rooms that gets people to focus in very special ways. In 1973, the CBOE's founders played a role like the one that the Wright brothers did in 1903. They started out with an old technology. After all, they were bicycle builders from Dayton, Ohio. But the Wright brothers took the theory of flight and they pushed it further. They hardly could have predicted during their brief flight at Kitty Hawk that they were opening the way toward the future, toward jet aircraft, transcontinental travel, and voyages to the moon. Like the Wright brothers, the CBOE's founders took a theoretical, academic principle and they put it into practice. And now the fortunes of millions of investors enjoy huge new opportunities for growth. Since those very first days of trading in the spring of 1973, your volume has grown phenomenally. It's gone from just 911 contracts on your first day for call options only to about 700,000 daily contracts for puts and calls today. This celebration that we're all part of recognizes much more than your quarter of a century of effort on behalf of investors. These events are also, in a sense, a celebration of what works, especially when the financial community's spirit of innovation is left free to act with a minimum of interference. Your success has shown that the entrepreneurial drive is limitless and that the role of regulation indeed should be limited. It's no secret that when the options business started, most people at the SEC were critical. And as you know, some were even hostile. Your innovations provoked a lot of honest debate among people of very goodwill on both sides of the issue. The easy path certainly would have been to stick with the status quo, to dig our heels in, and not to change the old rules. But I think my predecessors at the Commission ultimately made the important decision to embrace change. We made the right decision. Your innovative ideas about trading were a challenge to regulators. The Commission was confronted by new types of securities and new methods of allocating risk, and that compelled us to alter our thinking. Certainly, it wasn't easy to change. It seldom is in business, in government, or for that matter, in any aspect of society. When the SEC was thinking through the question of what to do about options trading, the Commission was reminded of a truth that's simple in theory, but hard to put into practice. Regulation must always be strong enough to serve the public's needs, yet it must never become so tough that it chokes off innovation. A changing marketplace cannot be governed by restrictions that stifle its fundamental agility. The Commission, I think, eventually reached a balanced judgment when it considered the question of options in the 70s. We did a careful study of the new options market, and we decided that the naysayers were simply wrong. We recognized that the potential of options could be unleashed if it was coupled with a sound and tailored regulatory approach. I think that's an awfully wise approach to apply to all of our regulatory efforts as we move into the 21st century. Because the SEC in the early 70s ultimately had the wisdom to allow our markets to innovate, options have today become a viable choice for investors in managing risk and in allocating capital. Last year, the number of options on all 4 major exchanges increased to nearly 280 million contracts, up an astonishing 40% in a single year. Each of our options markets has contributed to that growth. The CBOE is the contract volume leader and certainly one of the chief innovators, creating products such as leaps and flex options. Amex took its in-house derivatives expertise and developed popular equity derivatives such as spiders and equity-linked notes. Philadelphia is the pioneer in currency option trading and has been recognized for developing a number of successful sector index products. The Pacific has seen impressive growth in its equity options business, becoming a leading market maker for options overlying many important Silicon Valley companies. And the indispensable foundation for these exchanges is the Options Clearing Corporation. It's the largest and most trusted clearing organization in the world for financial derivatives. When one thinks about or talks about systemic risk, there is a general recognition of the fundamental importance, the essential importance of our clearing operation. And certainly the OCC has done a simply wonderful job in that regard and has earned the trust of the public it protects. Of course, the success of the options market hasn't always represented a totally smooth ride. And I can recall frenzied calls from my predecessors, one when I was at the stock exchange by Harold Williams, urging me not to put on any new contracts, to go into the then notorious moratorium. And there's been a constant ebb and flow and political and business tension as we move forward. After the market break of '87, many investors soured on options and volume dropped precipitously. At that pivotal moment, the options exchanges recognized that they simply had to restore investors' confidence in their products in order to survive. Because after all, in options, as in all business, trust is more easily won than lost. And I think those leaders of option markets have been so astute in recognizing the importance of teaching the public, of educating them, of telling them how to ask the tough questions. Because a public that is informed is in so much better position to move forward and to understand and to propel the growth of something as innovative as and as important as the options business in the world today. So the U.S. options exchanges began collaborating through the Options Industry Council. Its educational campaign, focusing on teaching the responsible use of options strategy to retail users, has certainly helped establish investor confidence. While this effort has been a great success, we've got to do a lot more to educate the public about sophisticated financial instruments. There's been a lot of misinformation out there. There's been a lot of fear about some of the new products. There's even been an effort on the part of the Congress going back some years to regulate or do away with some of those new products, and that would be, in my judgment, a national economic tragedy. Education is the cornerstone of what we have to do to protect the franchise we have won so painfully. Working together, we have a collective responsibility to help investors understand the risks they might face, as well as the rewards they may enjoy. I think this is especially true since so many millions are novices, millions of investors who haven't seen a down market in 14 years, and that represents a special responsibility. As leaders and participants on the exchanges, your role in maintaining and nurturing the public perception of fairness and efficiency in our markets is critical. Education is critical. But confidence also comes from the belief that exchanges are governed and operated in the public interest, an interest that goes beyond those important people on the floor, those important people on the staff, those important people on the boards. Designation as a self-regulatory organization carries huge responsibilities. I can think of no better way to ensure fulfillment of those responsibilities than to have a substantial public representation on the board of every exchange. And that's why today I ask for your help in developing a more balanced board of directors. Reaching the right balance must be the hallmark of our efforts, both for market participants and for regulators. We must always remember that we have a duty to uphold the public interest. Looking to the future, responsible regulation, I believe, requires flexibility. As your business modernizes, the Commission commits to modernize our approach to regulation as well. We must pursue approaches that are adaptable to the continuing explosion of technological capacity and to innovative development of new derivatives products. To help meet that challenge, the Commission, just last Thursday, considered a pair of deregulatory proposals that are designed to help you be more nimble. We believe that these proposals will help you compete better with new trading systems, overseas exchanges, and the over-the-counter derivatives market. The Commission is proposing to allow exchanges to operate low-volume trading systems and to trade most new products without first receiving Commission approval. Under this approach, you would be able to experiment with new trading systems for up to 2 years. And more than 90% of all your new products would be able to go to market without any delay. That's a revolution. That's not evolution. I think this will put more pressure on the SEC to conduct thorough inspections of the exchanges, but it would free you from the often time-consuming pre-review process. The proposals underscore our commitment to enhancing the competitive aspect of U.S. exchanges without sacrificing investor protection. I so clearly remember when I was at the Amex, the frustration we felt as we waited what seemed like an endless period of time for the bureaucratic process to run its course before we began trading new products or starting new systems. I can remember dragooning Ken Liebler and Bill Brodsky and saying, when are we going to get approved? And they said it was the SEC. Well, that's got to have some impact on my thinking. I think our approach is a major step forward in helping reduce such frustration among exchanges, traders, and investors. An examination of listed options regulation is obviously important to all of you here, yet I think it's only half the picture. The rapid growth of the over-the-counter options market represents, I believe, a strong fundamental benefit to investors and new challenges for regulators. Over the past several years, we've examined the derivatives market, and we have resisted steadfastly any impulse to overregulate. Our goal is to work with the industry, not against it, in order to maintain public confidence in the essential soundness of our system. That's why the Commission has proposed a new limited regulatory structure for the over-the-counter derivatives dealers. Many of you know it by its nickname, broker-dealer light. As you know, U.S. securities firms have conducted much of their over-the-counter derivatives business in either unregistered or overseas affiliates because our regulations make it too costly, too burdensome to operate out of a U.S. registered broker-dealer. Let me assure you that we cannot be complacent in terms of U.S. supremacy of the world's capital markets. We have it today. We have it because of public confidence in a system which is unparalleled in the world in terms of the balance of both auction and dealer markets, which work in harmony in a way that hasn't been replicated. But we can't sit back and be smug about it. The advent of the European Union is going to create enormous pressure on this country with respect to the primacy of our capital markets. And this Commission is committed to doing everything in its power to retain that primacy by a sensible regulatory structure. As you know, our securities firms have conducted much of their over-the-counter derivatives business in either unregistered or overseas affiliates because our regulations make it too costly to operate out of a U.S. registered broker-dealer. Our proposal would provide a new category of broker-dealer for those that act as counterparties in over-the-counter derivatives transactions. This new entity would be subject to capital and margin treatment that is specifically tailored to the derivatives business. It would enable securities firms to more rationally pursue their business and to better compete with banks and with foreign firms. At the same time, it would improve our oversight of an important portion of securities firms' activities. My preliminary impression is that this is really the best of both worlds. The proposal would allow American firms to compete more effectively in the global marketplace without sacrificing protection of investors. Some observers have missed the point. They've suggested that the SEC is using this proposal as a way to reach beyond its jurisdiction. Clearly, this is not the case. This is not our intent. Our proposal merely seeks to give large securities firms the ability to voluntarily put their over-the-counter derivatives in one U.S. registered entity. Firms will only sign up for this if it makes business sense for them. Those who want to view the world the old-fashioned way, through narrow jurisdictional classifications, miss a key point. Major firms view their derivatives business as a whole, and they view it in global terms. If we want to work with the industry to build collectively, to build with consensus, an effective system of oversight, we have to recognize and adapt to this reality. It's essential to maintaining that delicate equilibrium between important free market forces and responsible regulation. As I said at the start of these remarks, it's always difficult to reach the right balance. Wise regulation can help create the background conditions that allow for and nurture a nation's prosperity. But we must never allow the guiding hand of regulation to become a deadening hand of bureaucracy. Driven by the spirit of entrepreneurship and liberated from unnecessary regulatory burdens, our markets will continue to create wealth. That's the deeper lesson within the story of the CBOE. A market that broke free of old ways of thinking and offered investors new ways to put their capital to work. As I begin my second term at the Commission, I can think of no better place than Chicago for emphasizing the theme that I consider to be vital for the continuing success of all of our markets, reaching a sensible balance between market creativity and regulatory diligence. The essential tools at our disposal are innovation, investor education, and a pragmatic approach to regulation. It's a pleasure and an honor for me to join you to help you celebrate your first 25 years of success. We'll all look forward to being back here again with you in another 25 years to celebrate your golden anniversary and to hail the success of the options markets as the CBOE and the OCC mark another milestone in your service to America's investors. Thank you very much.
Thank you, Arthur, for those very relevant remarks to what's going on in the marketplace today. Good morning, everyone. I'm Wayne Lutheringhausen, Chairman of the Options Clearing Corporation. I'd like to add my welcome to all of you and my thanks for participating in this anniversary event. Operating a clearinghouse may not be the thing that sparkling cocktail conversation is made of, but it has been central to the growth of the options market we celebrate today. In the formative years 25 years ago, we weren't trying to break new ground so much as we were trying to create a market in options by applying what we knew about commodity futures. Grain and livestock futures then could be volatile, and the participants needed to know that their trades were clear and proper funds had been posted by the next morning, not 5 days later had been common practice in the stock market back then. So we focused on three critical elements or principles that were new to securities markets but met the needs of our new options idea, namely significantly netting trades for customers, this we call multilateral netting today, certificateless trading, and next-day settlement. As a result, options were the first securities designed to be traded without a certificate, a necessity for next-day settlement, and the first mark-to-market daily. 25 years ago, when we were designing this system, we were simply focused on the market and a trader's need to know where he or she stood before the market reopened for trading the next morning. Yet when we join the powerful clearing principles, these powerful clearing principles, with the very powerful attributes of the standardized listed option contract, we had created the winning combination that led to an investment revolution. Finally, the great success that the options market has experienced over these years has provided us the path to becoming the common clearing facility for listed option securities in the United States, excuse me, a motto more than once copied since, to our AAA rating, the first ever granted a clearing organization by S&P, and the use of our risk and clearing systems around the world. I'm proud to say that many of the people who founded OCC, or as it was known 25 years ago, the CBOE Clearing Corporation, and who made this new way of doing business, are here today. My thanks for you for being there then and for being here now. I'd like to also thank our partners in this great adventure, the American Stock Exchange, the Philadelphia Stock Exchange, and the Pacific Stock Exchange, and of course my very special thanks to Bill Brodsky and the Chicago Board Options Exchange for their partnership today and throughout these 25 years. Now it is my pleasure to introduce the moderator of this morning's panel discussion on the investment revolution. The growth of options is clearly reflected in the growth of Terry Savage's career. Terry is regarded as a pioneer in financial television, having broadcast a broad range of programming in Chicago and nationally for more than 20 years. After appearing daily on the CBS television station here in Chicago for 12 years, these days Terry is a regular business commentator on PBS Nightly Business Report and a frequent participant on CNN, CNBC, and yes, even Oprah, where she offers advice on investments and personal financial planning. Terry also writes a weekly syndicated column on personal finance for the Chicago Sun-Times and is the personal finance expert for Barron's Online. She is the author of 2 best-selling books on money and is a director of McDonald's Corporation. Whoa. That must take some fancy footwork, mixing McDonald's hamburgers and a guest spot on Oprah. But perhaps Terry's most important qualification for leading this panel of investment experts is her own pioneering role in options as a founding member of the CBOE and its first woman trader. She has also co-edited an options newsletter and traded interest rate and currency contracts on the Chicago Mercantile Exchange. This morning, we've asked Terry to lead a panel that includes a Nobel laureate in economics, the president of the world's largest stock exchange, the CEO of one of the world's leading investment banking houses, the CEO of a leading investment company, and a senior officer of a security firm that has changed the stock brokerage business forever. I know she's up to the task and eager to get started. Terry, thank you very much. Please, ladies and gentlemen, welcome Terry Savage.
Well, thank you, Wayne. That was quite an introduction, and I'm delighted and honored to be here today. 25 years later, it's like old home week. I say hello to so many old friends out there and to so many distinguished leaders in the securities industry. Well, this morning on our Investment Revolution Symposium, our goal is to take a look back at the incredible growth and changes in the financial services industry, and particularly at the impact of options on the financial markets. But we'd also like to take advantage of our distinguished minds to peer into the future and see what they think is on the horizon as financial services companies these days continue to make headlines with their global mega mergers, and the markets make headlines as they power seemingly endlessly higher. So I'd like to invite our panel to come up to the stage now. I'll say a few more words. Please remember to turn your microphones on, and you'll find your chairs listed here. And while you do that, maybe I can have a little personal recollection of 25 years ago. I remember well opening day in 1973. Wayne mentioned that I had a seat on the exchange. I'd like to let you know that I actually probably had the only seat on the exchange that opening day. You see, I was very pregnant, and they took one look at me and put a stool over in the corner and said, "You sit over there." I truly did have a seat on the exchange, and there must be something to what they say about atmosphere at that point in your life, because my son, almost 25 years old now, just received his MBA from the University of Chicago last week and has embarked on a career in the investment business. So I have a very personal memory of 25 years ago. Well, I was smart enough to realize I was better talking about it than doing it, so my career moved on into explaining what was going on in the financial markets, both in television and the newspapers, talking about current events. Today, we have an opportunity to get out of the current events, briefly look back, and also look ahead. So we've asked each of our panelists to make some short remarks, and then we'd also like to take questions from the audience. There are 2 microphones set up on the side aisles about 5 rows back, and after our panelists finish speaking, we'd like to encourage you to become part of the program. We will start and ask each of our panelists to go to that microphone to make a few opening remarks, your personal memories, your thoughts on the markets today and again in the future. Our first speaker this morning is William R. Johnston, President and Chief Operating Officer of the New York Stock Exchange. Now, as the Wall Street Journal noted only yesterday, the CBOE has become the big board's largest customer, with hedging business from its options market makers accounting for an estimated 10 to 15% of New York Stock Exchange daily trading volume. So I guess you could say Mr. Johnston's in town visiting his largest customer. Billy Johnston's been a member of the New York Stock Exchange since 1964, rising through leadership positions both at the exchange and senior managing director of a leading specialist firm. He was named president in July of 1996, and in that role, among many other duties, he oversees new listings, operations, market data and technology, regulation, and of course, client service. So I invite Billy to the podium now to take a look back at history and a look into the future from his unique vantage point. Billy Johnston.
Thank you, Terry. With this august audience, I'd be surprised if Mr. Brodsky's option volume doesn't dry up today and that volume on the New York Stock Exchange suffers a severe hit. But it's a pleasure to be here, and I'm delighted to represent the New York Stock Exchange. And on behalf of all of us who toil at 11 Wall, I want to congratulate the CBOE, and we are proud to be a part of this great event. From the perspective of the New York Stock Exchange, the advent of listed options is one of the most significant financial developments of the 20th century for a number of reasons. Options provide a way for investors to hedge the risks inherent in their equity holdings, and that has made equity investors more comfortable with investing a larger amount of their portfolios in equities. This applies to not only institutional investors, but individuals as well. This has helped create an absolute revolution in equity ownership and trading. Trading on the New York Stock Exchange, the volume has grown exponentially. Average daily trading volume in 1973 averaged 16 million shares a day. Today it is 628 million shares a day. Today we have a shareholder base of some 60 million individual Americans who are participants in our market, and 130 million indirect participants through 401ks, IRAs, KIOs, you name it. These numbers have tripled in the last 25 years. But we have grown together. Of course, other factors have contributed to this growth as well. The end of fixed commissions, the development of futures, historically low interest rates, particularly in the last decade. The movement of U.S. companies towards equity rather than debt financing, and the trend among countries and companies around the world towards free markets and equity ownership instead of state control. But it is clear today that listed options have been a key driver of this growth. Today, listed option traders who did not exist 25 years ago constitute, in aggregate, thank you, Terry, the single largest contributor to New York Stock Exchange volume. Chicago has given our members not only one of our biggest customers, but also a means of dynamically managing the risks that they must assume to create the world's deepest and most liquid markets in stocks. Our organizations have a strong history of working together, both on the business side and the regulatory side. On the business side, during the 1990s, the NYSE has gotten out of our derivatives business so that we can focus our attention on extending our leadership in our core business. In 1993, as many of you know, our options business came right here to Chicago, and we understand that the people that came from New York are prospering and that their prospects are great. Thank you, Bill, for that. The NYSE had entered the derivatives business after major centers of liquidity had developed elsewhere. In talking with the CBOE leadership over the last couple of years, we recognized that the inherent value of our options business could best be realized by transferring it to the foremost center of the options business. The CBOE has brought to our former options unit the critical mass needed to make it successful. Our exchanges have also partnered in another important way on the regulatory side. We are both members of the Intermarket Surveillance Group, and we have on multiple occasions shared regulatory data and investigative data that have resulted in significant regulatory actions against violations of our rules and federal securities laws. We have together created a strong deterrent against attempts at manipulation and front-running across markets. Working cooperatively, we provide the world's highest level of investor protection, no matter what the product or what the market. I wanted to point out one other benefit flowing from the development of listed options, one that we are only beginning to realize today. By virtue of the market breadth and liquidity that is generated by the interaction of stocks, options, and futures, the United States has developed a globally competitive financial services industry that is the envy of the world. Companies and investors throughout the United States and around the globe have come to rely on the access to capital and to liquidity provided by our markets and by our financial industry. This positions America for economic leadership as the world moves towards market-driven economies and will also help emerging nations develop their own markets. The emergence of those new markets will bring greater activity to our own in a cycle of continuing growth and prosperity. From our vantage point, the Chicago Board Options Exchange over the last 25 years has amply demonstrated the value of listed options as an important tool in the world of investing. The future of listed options is brighter still. Take it from a market that turns 206 years old next month. The best for the CBOE is yet to come. Thank you very much.
Thank you, Billy. I must inform you that the Options Exchange is very busy, very open for trading. I asked where Gary Leahy was, and I was told, oh, he couldn't leave the trading floor, even for this symposium. So they're over there trading and sending business your way. Our next speaker is well known in Chicago as well as on Wall Street. Philip Purcell is Chairman and Chief Executive Officer of Morgan Stanley, Dean Witter and Company. He started out right here in Chicago at Sears, where he was responsible for launching the Discover card, an interview I well remember. How could anyone break into the world of credit cards? Well, as big as a success as that venture was, it wasn't enough for Phil. He went on to lead the Sears spin-off of Dean Witter and negotiated the merger with Morgan Stanley just a year ago. Now, Morgan Stanley has been a longtime leader in using options to redefine the world of investment banking transactions. What seller of a company wouldn't want an options collar these days to protect his newfound investment in the acquiring company's shares? What CFO of a major corporation wouldn't think of using options to enhance the strategy of a stock buyback program? Options, an investment banker's tool. Who would have thought that possible 25 years ago, or perhaps even a decade ago? Please welcome Phil Purcell.
Thank you, Terry. It's an honor for me to be here. I don't think I've ever been in more distinguished company. Not only the SEC chairman and Bill Brodsky, but president of the New York Stock Exchange, two distinguished industry colleagues, and also a Nobel laureate in economics. This is the first time that I've met Professor Scholes, but he's had a significant impact on my life. It's his famous options model that makes it possible for the Wall Street Journal to publish my total compensation package every January. Now that I've had the pleasure of meeting the brilliant Dr. Scholes, I'm going to ask him to call my wife and explain to her where the money is. We're here today to celebrate the founding of the SIBO. In the years since then, the SIBO has played a pivotal role in the tremendous growth of U.S. capital markets. From the outset, the impact of the SIBO went well beyond listed options. It really legitimized and paved the way for the development of the entire derivatives market, bringing new technology and innovation to our customers. Arthur Levitt and Dick Grasso were both in New York back then, and I'm sure they'd agree that the founding of the SIBO was like a fresh new wind blowing out of the West. The great size, depth, and vitality of today's capital markets would be inconceivable without what was started in the Smokers Lounge in Chicago 25 years ago. To paraphrase Winston Churchill, that was some smoke. My company, Morgan Stanley Dean Witter, is a good example of the dramatic change that has occurred in the last 25 years, and change that is still continuing. In 1973, Morgan Stanley was a proud and highly successful advisor to a Wall Street firm that was basically an advisor to investment banking clients. But in the 70s and 80s, as deregulation of the industry took hold, Morgan Stanley transformed itself through a major expansion of its sales, trading, and research capabilities, and it became one of the first U.S. securities firms to expand globally. The transformation of Morgan Stanley, under the leadership of Dick Fisher and others, coincided with the rapid growth of the SIBO. In each case, the same forces were at work, particularly the need for innovation in a new, deregulated environment. It's no exaggeration to say that Morgan Stanley and the SIBO became partners in extending the use of derivatives to customers and providing innovative products. Today, Morgan Stanley Dean Witter is proud to be the largest clearing firm on the SIBO, and derivatives have now become a major part of our equity business. The SIBO has also had a very important impact on the growth of Dean Witter, or the retail side of our business. In fact, from the very beginning, the exchange has played a crucial role through the innovative use of new technology that has benefited individual investors. I hope I don't get into a historical dispute with my friend Billy Johnston on this, but I believe it was the early adoption of the automatic order and routing system at the SIBO that helped spur the New York Stock Exchange to implement its DOT system for individual investors. Later, the SIBO's RAISE system, Retail Automation Execution System, began with 108 contracts in the first month and today it handles nearly $1 million a month, consisting entirely of small orders from individual investors. Today, you will still hear the argument in some quarters that options are not suitable for individual investors. But there is one thing that everyone should agree on. There has never been any question that individual investors have always had equal footing at the CBOE. And in providing speed and easy access for the retail market, the CBOE has clearly shown great foresight and leadership. It was not too long ago that people were talking about the demise of the individual investor. But with individual investors now owning 65% of the financial assets in the U.S., up from 45% just 10 years ago, no one any longer doubts the enormous power of this market. In fact, it was the distribution strength of Dean Witter, its relationships with individual investors, that could be combined with Morgan Stanley's institutional strengths that brought the most recent transformation of my company, the Morgan Stanley-Dean Witter merger, just a year ago. So given the importance of the CBOE to my company over the last 25 years, it's obviously a great pleasure for me to be here with you at this celebration. Let me conclude with just one or two thoughts about the future. First, I believe we will see a significant expansion in the use of equity derivatives over the next several years. Equity derivatives are still, believe it or not, a relatively untapped market compared to the fixed income market. Today, virtually every fixed income instrument involves a derivative in some form. But in equities, derivatives are used in only about 10% of the overall market and the overall transactions. With stock prices at their current lofty levels, we can expect more investors to look for derivatives as a way to both enhance future returns and protect their gains. I believe we can also continue, and especially after today's speech, I believe we can also continue to count on continued wise regulation. What Arthur Levitt refers to as regulation with a light touch to help fuel this expansion. The repeal of the short limits for mutual funds, for example, will bring expanded use of derivatives in that remarkable growth sector of the market. The challenge for the CBOE is to make sure that it has the capital needed available on the floor to handle the increased demand. As institutions and money managers expand the use of equity derivatives, the size of trades will continue to increase. Today, about half of our trades on the floor involve trades of 1,000 contracts or more, a size considered huge just 5 years ago. If the CBOE is going to continue to play a central role, it's vital that capital is accessible downstairs, on the floor, in order to spread the risk of these trades. A second challenge for the CBOE lies in capturing the full promise of electronic trading and the internet. I realize that at every symposium, in every industry these days, everyone feels they have to talk about the internet. And the talk's always easier than concrete action. But there is no question in my mind that the potential is very real and the opportunity is already at hand. One of our fastest growing businesses is an entrepreneurial online trading service for individual investors called Discover Brokerage Direct. Today, 70% of our trades at Discover Brokerage Direct are on the internet, and we're doing more than 10,000 trades per day. And in what is directly relevant to today's discussion, over 20% of the orders on Discover Brokerage Direct are for options. That's way more than twice what you would expect in a normal broker-dealer. And I think the reason for that is that our online customers are young, sophisticated, and aggressive investors. And this is just the beginning. One of our responsibilities, which we share with the CBOE, is to monitor the potential risks to our online customers and make sure they have the information and education they need regarding the use of derivatives. That has always been the case, and it has always been one of the strengths of the CBOE. Back in 1975, when the options market was still relatively new, the president of Dean Witter sent every branch manager, more than 100 of them, to Chicago so they could take the SIBO training course and become registered option principals, even though it was not required. Today, with online trading poised for explosive growth, the need for SIBO education programs through the Options Institute and other avenues is more important than ever. There is no question in my mind that the SIBO will be equal to the challenges and that it will continue to be at the forefront of innovation in our industry. Since Arthur Levitt is here this morning, I'd like to conclude my remarks with full disclosure on the reasons for my optimism about the future. I have to disclose that my family's future is where my mouth is. I have one son who is a managing director leading the equity derivatives business for a fine competitor of Morgan Stanley Dean Witter. And I have another son who is employed here at the SIBO. So with both of their futures clearly tied to the options market, I am an honest believer. Thank you very much.
Thanks, Phil. We'll give you and Billy a chance to debate about how DOT was started later on in the program. But we should mention, I'm sure many of you read the recent Barron's article that named the Discover website, the Discover online brokerage, #1. Of course, not far behind was the Schwab website. So let us move on quickly. Charles Schwab, that name, has revolutionized the retail brokerage industry, made discounting available to everyone, and then took it one step further with online brokerage. And in fact, I was at an awards dinner here in Chicago Monday night at Comdex, where the Charles Schwab website was similarly honored to your Discover site as the #1 commercial website on the internet. So whether you're an investor or a techie, and I guess that's probably synonymous these days, all the techies are the ones getting rich, they all know the name Schwab, and so many are trading online. In fact, did you know, with its more than 1 million online customers, more than half of Schwab's business is done online at its website? And for those sophisticated investors, large and small, options are a big part of their business. Schwab is as big a retail player as there is in options. Now, representing Schwab this morning is Jim Hackley, Executive Vice President and head of the National Investor Service Centers for Charles Schwab. What that means is if you pick up the phone and talk to a Schwab representative, you're talking to one of Jim's well-trained people. So let's find out what he is telling those Schwab reps about the role of options in their customers' investment strategies. And by the way, before I bring you to the podium, Jim, I asked everyone here if they would, just give a little harken back to where they were 25 years ago when the CBOE started. And they told tales, as you're hearing, of being at various firms on the street. Jim said to me, well, I was actually a junior in high school. Business is moving on, Jim Hackley.
Thank you, Terry. I, too, am honored to be a part of this august panel and to be here to recognize the accomplishments and achievements of the Chicago Board Options Exchange and the Options Clearing Corporation. David Pottruck, the president and co-CEO of Schwab, regrettably was unable to attend the event because of a prior commitment to the board of directors. And as Terry alluded to, I think he would have had an easier time hearkening back 25 years to a salient experience. When I go down that path, truth be told, and potentially at the risk of being politically incorrect, I was having a good time playing cowboys and Indians with my boyhood friends. Schwab, like the CBOE and the OCC, are modern entities. Schwab will celebrate its silver anniversary early next year. We have quite literally grown up together. I can recall my first years at Schwab in the early 80s, learning at the feet of the masters, which basically means, shagging lunch and stuffing envelopes and filing. Filing was something that I was particularly good at. I knew the alphabet cold. And it went like that for some period of time until I was registered and found myself on the phones placing trades, hundreds of trades, for customers. In time, I was investing millions of dollars on a virtually daily basis for customers in stock, and I became quite comfortable and competent at it. Yet there existed a type of order and a stereotypical type of customer that struck fear into the heart of Schwabies. Would be options and the option customer. It wasn't a binary world anymore from our perspective. Buy or sell is relatively easy, relatively straightforward. With options, however, it's buy calls to open, or sell puts to close, or sell puts to open, and it doesn't stop there. There were straddles and spreads, combos, vertical and horizontal, and I can recall one customer I had early on who told me firmly and confidently that he wanted me to help him place a time-weighted diagonal iron butterfly. I asked him to spell it. And then there's the customers themselves. At times they were ruthless. As soon as the order was off their lips, they expected it to be on the floor. I had the distinct sense that they had a Quotron on the one hand and a stopwatch in the other. Is it in yet? Is it in yet? Immediately followed by, I think I'm due a fill. But those were the early days, and it is much different now, very much different now. Options are recognized and an accepted vehicle for investing and are becoming more and more a part of our customers' portfolios. While options aren't yet mainstream, like mutual funds have become, they are definitely on Main Street. Many customers now use them to increase their total return, hedge their portfolios, simply leverage their capital, as well as other things. Options have proven their worth in the marketplace, due in large part to the efforts of the CBOE and the OCC over the last 25 years. The next 25, I'm confident, will be even more exciting. I do feel compelled to mention the internet, which has already had a profound impact on our industry. It is accelerating the pace of change. I think maybe even more so in our industry than in any other. Investing is an ideal foil for the internet because investing at a fundamental level is all about transactions and information. And the internet is ideally suited for those two functions. To emphasize the growth of this channel, I'd like to share some of Schwab's recent results for the first quarter. Luckily, I chose different stats. Active online accounts at Schwab in the first quarter grew from 1.2 million to 1.5 million. The assets associated with those accounts went from 80 billion to 112 billion. That's 25% and 40% respectively, with a little market appreciation thrown in. And that's in 3 months. Notably, as well, as Terry mentioned, in March, for the first time, over half of the firm's trades were placed via the electronic channel. And it's accelerating. Technology has and will continue to change our industry. And from Schwab's perspective, the CBOE leads the option industry in this and other regards. Again, I am honored to be a part of your celebration, and I too look forward to being here for the golden anniversary. Thank you.
And you have a pretty good shot of being here for the golden anniversary. Phil, you and I and the next generation will watch. What an interesting, terrific panel this is. As you've noted, you're going to get a perspective of options, past, present, and future in the financial services industry from a variety of perspectives. And how exciting to have Ken Liebler here to do a part of that. He is President and Chief Executive Officer of Liberty Financial Companies, former president of the American Stock Exchange, and one of a select group of today's financial executives who actually got their start in the options business. Some of us are old enough to remember Marsh Block Liebler, one of the leading firms in the old OTC put and call market. So Ken's been around for a while. His youth belies it, but he was named president of the Amex at age 36, the youngest president of any exchange in the world. And before being named president, he directed the options marketing and oversaw the growth of much of the American Stock Exchange options business. Well, all that experience has gone with him to Liberty Financial, which manages $52 billion worth of assets through 75 mutual funds, an array of private and institutional accounts. And you know the names Colonial Group, Steinrow and Farnham, Newport Pacific Management, and others. So let's have a perspective on how professional money managers particularly are now using options to enhance performance. I hope that Ken will touch maybe on the recent tax legislation repealing the short rule that makes it much easier for mutual fund managers to use options. And so from the institutional side and a vast historic perspective, Ken Liebler, CEO of Liberty Financial.
Thank you very much and good morning. As Arthur Levitt indicated, it is a bit of an old home week. My comments today, though, on the significance of the options revolution really come from three somewhat different personal perspectives, as Terry just indicated. I spent the first few years of my career working for what was called a put and call broker-dealer, which seems an archaic term today, but these were the predecessor firms of listed options trading. And I see I'm not the only one. I recognize Irwin Guttag and Paul Stevens and Leo Pomerantz and others who were clearly around in those days. I then spent about 15 years helping to develop the listed derivatives business at the American Stock Exchange. And finally, since 1990, I've been more of a customer of the options industry, complaining about executions and so forth, in my capacity overseeing a rapidly growing asset management business. But before I get to those perspectives, there's a story often recounted in the money management industry that I'd like to share with you, and it involves two friends who often take vacations together in order to photograph wild and exotic animals. In the current instance, they decide to go to the Ozarks to take close-up pictures of some of the world's largest bears. Upon arrival, they hire a local guide who takes them on this 3-day journey deep into the woods. But the guide's advice is clear. You can get within, about 20 yards or so of the bear, but not closer. Because if the bear looks at you and he locks eyes with you, he'll likely charge, and they're capable of covering ground with deceptive speed. So our two adventurers, upon seeing a huge male specimen, inch closer and madly photograph him from behind. And finally, they're about 10 yards away, and the bear abruptly wheels around and locks eyes with our friends. Instantly, while both drop their cameras, one of the men removes a pair of running shoes from his backpack and starts lacing them up. And his friend asks, "Why are you taking the time to put on running shoes when you know we can't outrun the bear anyway?" His pal replies, "Oh, I know I can't outrun the bear, but all I have to do is outrun you." Now, this somewhat morbid tale, I think, reminds us how competitive all of our businesses can be. It also hits home the fact that competition is often quite relative, and outperforming one's peer group can sometimes be as critical as delivering absolute gains. And certainly those of us in the asset management community know this lesson all too well. Performance is sliced and diced every which way and measured daily against a seemingly unlimited variety of categories and competitors. So against this backdrop, it's certainly no surprise that options and other derivative securities were latched onto early by certain professional investors anxious for a new tool to enable them to outperform their peers. Limiting risk, reducing transaction costs, leveraging market exposures, all commonplace concepts today were virtually unknown to the money management community prior to the advent of listed options in 1973. In fact, the creation of a listed secondary market in options further spurred the ingenuity of other would-be financial engineers. And I believe this directly led to the amazing proliferation of derivative securities and instruments during the last few decades that has so fundamentally revolutionized our industry. Today, money managers routinely use options to reduce risk and enhance performance. But such explicit use of these instruments was either unheard of or actually illegal as recently as 20 or so years ago. In fact, the Liberty Financial Company, the Colonial Group, launched one of the first mutual funds to explicitly utilize options as an investment vehicle, the Colonial Option Income Fund. Prior to the launch of that fund in 1977, over 20 years ago, Colonial and other industry executives spent over 2 years convincing regulators and distributors that the writing of covered calls was not speculation under the various state and federal gambling statutes. This is just one example of how the institutional use of options has slowly but surely become legitimized over recent years. There are literally dozens of others. But the more subtle or behind-the-scenes role options have played within the financial community, I think, receives a lot less attention. Unknown to public or even professional investors, options are often a hidden ingredient necessary to the creation and marketing of other financial products. I'm reminded of the oil embargo of the 1970s, when so many of us realized for the first time how critical petroleum was to the manufacture of cars, plastics, and literally thousands of other everyday items. So too with options. Index-based securities, a product we market, equity index annuities, and many, many, many more important retirement-oriented products simply could not be offered today to the public efficiently without the ability of providers to hedge their balance sheet risk with options. A final but unheralded contribution the listed options industry has made to our broader community relates to what we see here today, the production of a remarkable past or current presidents of the Chicago Board Options Exchange, American Stock Exchange, Chicago Mercantile Exchange, Options Clearing Corporation, and Hong Kong Futures Exchange all worked together in the early days of the Amex Options Division over 20 years ago. As a member of that group, I can tell you it was a lively and invigorating experience. The need to compete head-to-head with other exchanges for order flow, unheard of within the exchange community at that time, was a transforming event. More than any other single factor, I believe that daily competitive battle drove countless innovations in product and technology in subsequent years. The benefits of options trading were extended to more and more underlying securities, both listed and also over the counter. Transaction charges came down and were often waived in exchange for order flow. Automated executions were pioneered. Each innovation led by a small but creative band of young industry leaders, at least young at that time. But beyond financial industry figures, renowned academics, among them Nobel laureate Dr. Myron Scholes, who you'll hear in just a moment, made their marks in options. Key government officials, including SEC Chairman Levitt and Treasury Secretary Rubin, spent important parts of their careers overseeing options operations. Practically everywhere I go in the mutual fund and annuities businesses, I encounter friends from the old options days, now currently leading some industry activity or another. In the final analysis, I believe that the impact of options people on our wider community may well be the industry's most vital contribution to the next 25 years. Thank you.
And I know we're leaving the door open for a lot of questions. I'd like now to introduce our final panelist. The name Myron Scholes is just synonymous with options, whether you're a floor trader or an economist or a mathematical theoretician, or perhaps as I am, a member of a corporate compensation committee. You wrestle with the options. Phil, I should also point out that on the compensation committee, maybe I can't say this publicly, so we'll keep this in the room. We always hope that the Scholes-Black model will actually prove a conservative discounting of future value of those options. Maybe I should talk to your wife. Because of that incredible pricing model which Professor Scholes co-authored with the late Fisher Black, options valuations are really part of the daily financial picture of millions of Americans, both as traders, investors, and even as employees. And recognizing that reality, he was awarded the Nobel Prize in Economics in 1997, along with Professor Robert Merton. Today, Professor Scholes is a principal and co-founder and limited partner at Long-Term Capital Management LP, an investment management firm based in Greenwich, Connecticut, and proving he can truly do it coast to coast. He is the Frank E. Buck Emeritus Professor of Finance at Stanford University, where he's taught since 1983. And of course the Chicago connection, because before that he was on the faculty of the University of Chicago from 1974 through 1983. I could read this distinguished biography for the next 5 minutes, but that wouldn't leave us time to hear the views of the man who literally was such an integral part of creating the options market, Myron Scholes.
Actually, I too have the same problem as you do. My wife wants to know where the money is when I tell her that I hold Morgan Stanley options. Happy birthday, Chicago Board Options Exchange and OCC. It's tremendous to be here with you. And actually, when I was at the university starting off, my paper went from not being approved and with great difficulty subsequently being approved. So we grew up together over this time period. Being awarded the Nobel Prize in Economic Sciences this year for contributions to option theory and risk management has been a truly wonderful experience. Robert Merton, my co-recipient of the Nobel Prize this year, has not stopped smiling since October 14th, the date of the announcement. I thank the Swedish Academy of Sciences and all of those from around the world who have recommended us for this great honor. When asked about the trip to Stockholm and the festivities surrounding the award and the ceremony itself, I say everything was great. If you get the opportunity to do it, don't turn it down. Given the Nobel Foundation and Sweden has hosted the awards ceremony since 1901, they put on really a terrific show with your own attaché to handle all your circumstances and your every need in terms of details of your activities, and your driver being available at all times to assist you. One becomes extremely spoiled. Alas, on my return home to Greenwich, it was necessary to go to the store and get some milk. I sat in the back seat of my car and did not go anywhere. On a more serious note, I wish that Fisher Black had lived to share the honor with us. He was obviously integral to the development of the Black-Scholes option pricing technology. It is called the Black-Scholes option pricing model, or just the Black-Scholes model. We all miss Fisher as a friend and colleague, and Bob Merton named the model the Black-Scholes model, and I thank him for that. I was skiing a couple of weeks ago at my home in Deer Valley, Utah, and I occasionally try the race course. It is necessary to sign a release form. The attendant there, when seeing my names, asked whether I was the Shoals of the Black-Scholes model, and being curious, I asked him how he knew of my work. He claimed to be a 1995 PhD from MIT in economics. I did not realize that the program had gone that far downhill since we had left way back. Today I would like to talk a little bit about spreading the word in options. I will concentrate on the first few years after the development of the Black-Scholes model to illustrate really the genesis, I think, of applied risk management techniques. And it wasn't that easy. Derivatives and options were not in the forefront of anyone's thinking. In fact, Fisher and I could not even get our paper published. The journal Political Economy rejected it initially, even though subsequently it was the most cited paper ever. They claimed that options were too narrow focus and didn't have really a view or an application to economics. The Review of Economics and Statistics also rejected it. After Merton Miller and Eugene Fromm of the University of Chicago interceded on our behalf, the JPE agreed to review it. And they did subsequently publish it. As happened subsequently, the trading of financial derivatives on organized exchanges has exploded since the early 1970s, and the trading of off-exchange financial derivatives on the so-called over-the-counter market has really only exploded since the mid-1980s. So we have a relatively young industry in over-the-counter activities, but there's a lot of interaction between the options markets and the other financial markets, futures markets, as well as the over-the-counter market. Academic and implied research on derivatives has exploded as well since the early 1970s. I would like to make the point that the exchange industry and the over-the-counter industry used and applied option pricing technology to build the first quantitative and successful risk management systems, not because some regulator told them to do so for accounting or other purposes, but because their businesses could flourish only if they adopted the new technology. They could economize on the use of their capital by controlling risks, and lowering their capital costs improved their competitive advantages. When we worked on the option pricing paper, there was no organized exchange in options. After discovering our results in early 1970, we tried to trade using the option pricing model technology that we developed. There was a market in options at that time. As was alluded to before, members of the Put and Call Dealers Association would sell puts and calls. They would advertise in the Sunday New York Times and in Barron's. I would price and rank the options by those best to buy. First thing Monday morning, I would be on the phone to New York, trying to buy the most undervalued contracts. Unfortunately, they were always sold out. But they had other options that I might want to buy, and this was my first introduction to bait and switch. Transaction costs were high to deal in that market, and using empirical evidence, they tended to use feel and to build in spreads to make a profit. The Chicago Board of Trade was sponsoring the development of an options exchange in the early 1970s. They commissioned many studies to show the economic rationale for option trading. Although I did not participate in those studies, it seemed obvious if there was a demand to hedge transactions or to acquire assets in alternative ways that were more efficient than the current markets, the options market would survive and prosper. Transaction costs were the key. I was first introduced to Wall Street through being asked by Mike Gladstein via Paul Kuttner to work on pricing of down-and-out option contracts for Donaldson, Lufkin, and Generette. Bob Merton and I teamed up to price these contracts for them. We met some of the great traders, such as Leo Pomerantz at that time, who subsequently became the first chairman of the Chicago Board Options Exchange. It became apparent that the Chicago Board Options Exchange was going to start in 1973. Leo and Mike asked us to write some of their option pricing technology. I remember the first days of trading of these options on the Chicago board. Mike Gladstein phoned me up and said that the model must be wrong. The prices were far different from market prices, especially as the underlying stocks deviated from the exercise price of the options. We recorded the prices, and I said I would phone back. On phoning back, I said that using the model as a guide, as a way to hedge your net exposures to the underlying assets would be very profitable. Go for it. They did. And Donaldson Lufkin profited handsomely. But the derivative exchange industry and the derivative academic industry grew significantly from the initial time period. And financial economists and academics started to interact with a broad set of practitioners, and this led to a cross-fertilization of ideas among participants of both industries. The options pricing technology was adopted simply because it reduced transaction costs. But without a model, traders can either price securities with embedded options with sufficient accuracy to compete against other traders with models, nor could they reduce the risk of their positions to employ their capital efficiently at a low enough cost to compete with other traders. Although it was hard to prove, I do think that the success of the Chicago Board Options Exchange and the other exchanges in part can be attributable to option pricing models. As traders became familiar with these models, bid-offer spreads narrowed. As traders became more familiar with risk management techniques, they could take on larger position sizes to support the market. With a deeper and more efficient market, investors began to use options to facilitate their own investment strategies. In fact, Texas Instruments marketed a handheld calculator in 1974 that gave the Black-Scholes option values and hedge ratios. When I asked them for royalties, they replied that our work was in the public domain. When I asked them at least for a calculator, they suggested that I buy one. In retrospect, one of the greatest inventions of that time was the growth of the financing firms. Those firms that financed the books of the floor traders or market makers on the exchange. Firms such as First Options or O'Connor's Associates work with banks such as the First National Bank of Chicago to finance the positions of the seat holders. O'Connor was subsequently sold to SBC, and the talent from that organization took over many of the most senior positions at SBC. Now, Swiss Bank Corporation and UBS have merged to become UBS again. And many of those same innovators who built those initial risk management systems in 73 to 75 are running the trading and capital market divisions of the new bank. In fact, I'm convinced that one of the reasons for the merger was a talent merger, having these talent to be able to control risks. In the early days, most of the seat holders really had sufficient capital to buy a seat, and that was about it. They put up the seat as collateral against their positions financed by these firms. If the market moved and they were not hedged, they would lose a considerable amount and potentially their business. All of the positions were cleared through the clearing firms. The firms put up their capital to back the market makers. Computer programs were built to net the positions and to finance the net exposures of traders during and at the end of the day. This was the first and truly important surviving application of finance theory in practice. It was necessary and it is the forerunner of the risk management systems today. Every risk management system that we see in place now and in the future will have the 6 elements that were necessarily put into place by these firms in the 70s. One is to translate the exposures on the underlying options into the underlying securities. Second is to determine what exposures the underlying securities have to systematic factors and to residual factors, and then to decide which factors to hedge each day. This allowed the traders to survive. The third element, as a byproduct of this risk management system, the traders knew whether they were making profits, and the clearing firms could decide whether to retain them as clients. They could optimize their portfolios. The fourth element was that clearing firms were always updating their estimates of volatility and refining their models and computer programs as they garnered data. They continued to check the trading positions and the hedging positions to make sure they were working. And fifth, most important, they had to limit the size of the books of the market makers. The market makers had to have sufficient liquidity and reserves to handle crisis situations. Large, unanticipated moves in the market could wipe out not only the traders, but the clearing firms. They had to plan how to hedge and how to handle crisis situations. The sixth element was they had to provide the correct incentive system for their market makers. They wanted them to survive and profit for the clearing fees that they would provide. Many market makers failed. However, the risk management systems provided the correct incentives and controls to prevent the market makers from using other people's money to profit on if their trades worked out, and to put the losses to the clearing firms. These six elements are the crux of any modern risk management system, that which is now talked about as being crucial for banks around the world. It was in place here in 1973 through 1976. I think this is an amazing but untold story. The early pioneers in using advanced finance techniques and computer technology were far ahead of their time. They have moved into the banks in the 80s and will move again into the corporations in the years ahead with the growth of the OTC market. One last story before I sit down. One day in 1977, I was returning from a trip and was picked up by a taxi driver who had a copy of Milton Friedman's Capitalism and Freedom on the front seat of his taxi. I asked him why he was reading it, and he said he was an educated person and he knew several professors at the University of Chicago, one being Professor Scholes. Being sheepish, I asked him how he knew Professor Scholes. He said he had once heard Professor Scholes give a talk to 700 market makers on the floor of the Chicago Board of Trade when put options were first introduced in 1975 on the Chicago Board Options Exchange. He traded put options. He lost money. He started to drink. He lost his girlfriend, lost his seat. He crashed his car, ended up in the hospital with a broken leg and no money. He was now working his way back. I was very worried that he might recognize me. He continued that driving the cab gave him a chance to regain his perspective in life, and he was going to make it back. Alas, he said that if he only listened to Professor Scholes and how I should think about trading put options, I would not have gone broke. Instead, I should have known better. I thought I knew better. I ignored the distinctions between puts and calls. When I left the taxi, I paid him, and only then did I tell him I was Professor Scholes. I was still hedging. He smiled. Thank you very much.
Thank you. That was fantastic. And a lot of us were there and lived through it, but I didn't quite understand it at the time I do now. Before we start our questions and answers, let me ask you to put on your futurist hat. I won't ask you to tell me where the Dow tops out, but you know, in the options prospectus, there's risk and reward, the little red legend on there. Let me ask you to apply some of your thinking about the future to the subjects of risk and reward, or put it better, opportunities and potential pitfalls. When I say the word opportunity, things come to mind like seamless global markets, liquidity, creativity. And when I say pitfalls, I think about, yes, there will, maybe, I suppose, perhaps someday be a time when the market does have more than a 10% decline. I think about the year 2000 issue. I think about global competition. I think about regulation. So let me just go up and back first and talk about what you see first, if you'd go through it, as the potential opportunity that you see greatest and how you would position yourself in the industry to capitalize on it. And then let me go back through the line and ask you for what what keeps you up at night, what you think are the potential pitfalls and how you're hedging against those. And Billy, could I start with you, the opportunity, and just speak from your chairs. We'll go right here and then we will take your questions.
Well, we expend our energies and our income, if you will, these days on technology, looking at ways that technology can make the business better for everyone that wishes to invest in equities, We have no market commentary, Terry, as you know, as to whether the Dow will go up, down, or sideways. We just want to make it better for investors to be able to interact in our marketplace. Through that, we are experimenting with some handheld technology, which other markets are doing. We are concerned constantly about regulation and making sure that we provide the best regulation that we can as a self-regulatory organization. And finally, I guess to your global point, the opportunity would be the world is only getting smaller, that we continue to try and list the world's great companies on the New York Stock Exchange.
Okay, Phil, you're noted for being on the cutting edge of what's next. I can't wait to hear what you think about where the opportunity is, and I'm going to hold you to this personally this time.
Well, no, I don't want you to do that, because we have professionals who make projections, and I try to avoid that. But I think if we look at it from the point of view of our clients who tend to be investors, that the great things that are happening for them, number one is the explosion of information and the availability of information to all investors, whether they are retail or institutional. And secondly, the explosion of technology that makes them able to use it, whether it's for a simple asset allocation model for an individual investor or a very sophisticated derivatives application for institutions. So I think the opportunity is both the combination of the technology and the information that's available to help people invest better. And I think if we take the long view, which is the only view that's appropriate for an investor, I would continue to be bullish, even though all of us are nervous at current market levels. So I think everybody's going to be in a better position to make better decisions, and that would be my most positive feeling today.
Okay, without pushing you on the forecast, that's not what I meant to do. How will that combination of information and the technology to use it, how do you see that making financial firms such as yours look different in 5 years, 10 years?
Well, it's the major positive, I think, is that it's going to make our clients wiser investors, and our clients will do better, and therefore firms will do better. How will it make the firms different? It's already doing that. If you look at the composition of the talent that we hire and pay and promote in our firms today, much more of it is technology driven and sophisticated in information technology, and that I would say will be a huge change in the control structure, and the sophistication of the control structures and risk management structures has to change. So the kind of people that we have to attract and motivate and keep continue to get smarter and smarter and more different than the management.
That's interesting. All right, Jim, you are going to be here 25 years from now, so be a real futurist. What will it look like, do you think?
And you're going to hold me accountable.
I hope I'm here to do that, yes.
I think from Schwab's perspective, we view the next wave really as centered around advice and guidance. Previous waves from our perspective, I mean Mayday and the democratization of mutual funds, moving into advice and guidance, and what's really happening on the web with the proliferation of information being available. If we look back from our personal experience at what was successful about the mutual fund marketplace, it's essentially we provided a safe environment, an unbiased environment that had a broad array selection of different vehicles and tools, and we feel as though that approach will win the day going forward. I think we'll all be challenged in how to help customers and clients filter all of that available information, because it is massive. And there are a lot of conflicting pieces of data that are out there.
But that's interesting to come from Schwab, who started out as, a customer's do-it-yourself firm will be the best transaction platform. Are you talking about individual hand-holding, or are you talking about filtering, creating places where customers can filter their own information?
I think both. it really needs to be determined by the customer. You need to assess their situation, find out if they are in need of greater help and guidance, or if they are quite comfortable doing it on their own. And there isn't just one type of investor. The baby boomers, which is often talked about, they're aging. I think they're becoming much more comfortable with investing and are more capable of standing on their own.
In other words, you're after everyone's customers. Kent, the future, what's the greatest opportunity? All of a sudden, we've seen, 90% of all the money in mutual funds has come in the last 8 years or so, and by the way, has never seen a 10% correction. What's the opportunity? I'll come back to you for the pitfalls as well.
Well, I think some of what was said I would agree with. I think, to me, the great opportunity is in advice and in asset management. What's happened is, notwithstanding the explosion in technology and the availability of information, and of course that will create a number of do-it-yourselfers. What you really, though, have, the much bigger trend in my view, is the demographics, which we talk a lot about. But in this country today, every 7 seconds an individual turns 50, and we're talking about a generation that are the most undersaved generations in the history of the country. So you have 100 million Americans moving into their maximum savings years in their 50s, with enormous retirement needs ahead of them, enormous capital accumulation needs, and I think that trend is going to play out significantly over the next 10 or 15 years. Then you'll see the requirement for income, and we'll kind of go back to where we were in the past, where the focus will be less on capital gains and asset accumulation and more on structuring what I've accumulated to effectively carry me through retirement. So I think this enormous demographic wave is something that all of us in the business are going to have to contend with. I also would say that that same opportunity is also where I have my own biggest fears, because it, I think, conveys upon all of us in the business an enormous responsibility. As Chairman Levitt pointed out, most of the people operating in my businesses today, running mutual funds, not only, certainly never saw the crash of 1987. I bring it up quite a bit in meetings with my folks, and I'm the only one in the room very often that remembers that. And it is almost an inconceivable activity in the minds of people today running many billions of dollars. So I think there's a boldness, perhaps, to the investment process, and maybe not quite the respect for risk in the current marketplace that I would feel more comfortable with.
So looking back on the crash of '87, I remember in '73, '74, the joke on the floor was, did that stock have a 2-for-1 split or a 3-for-1 split? I remember asking an old trader, remember Paul Espenshade? I don't even know where he is, but he was standing next to me, and I looked up, and I don't know, it was Polaroid or Xerox that had come down from over 100 to the 20s or something like that. And I remember asking him, I looked up and I said, where did all the money go? And he looked at me and he said, well, my dear, it went to money heaven. Something I've kept in mind over the years. That is not a Black-Scholes pricing model, but Professor, could you look into the future? You've been so good at that along the way, and give us what you think the real opportunity is, not just for the stock and options markets, for the financial markets.
Well, I think one of the greatest, has been all alluded to here, but I mean, one of the greatest revolutions we've had is the change in computer and communications technology, which has allowed to a tremendous reduction in information asymmetries or differences as people have learned more. In addition, I think that there's also been a tremendous growth in financial technology and financial acumen in terms of being much more sophisticated in how we provide different products and services to clients and customers. And I think given that there's been this growth, that we also have in investment banks and very large corporations, we have whole teams of individuals who are so-called financial engineers who actually try to engineer financial solutions to customer problems. So the focus, which has always in the past been a product-oriented focus, I have a product, you're going to buy it, or I'm going to find customer A and marry that with customer B, is moving towards from a product focus to a client-oriented focus, or trying to solve the problem of the client. That's only because of this new technology and because of our financial acumen or financial knowledge and modeling capabilities. When you move to a client-oriented focus, the world just opens up tremendously, because it's the same as what happened sort of when I first bought a stereo system in the investment, just back when I was young, is you had a big box and you just bought what was provided, and then all of a sudden you had hundreds and hundreds of component parts and you had to figure out how to put it together. And that became more and more difficult over time as my attention drifted to other things. And then I realized in recent times you've had this thing called the media center. So now you have an expert who puts together for you and your particular needs what it is that would be the most and best system. And similarly, the same thing will happen in investment products in the future, namely that instead of investors having to choose from myriad mutual funds or myriad investments, that banks, financial institutions, mutual fund companies, etc., will try to provide products on their own name and then hedge out the risks, the systematic risks, either in the Chicago Board Options Exchange or other markets, to actually see about producing these products. They'll synthesize them as opposed to just being an assembler. And additionally, for corporations around the world, the options have changed the motivation from just stocks and bonds. Don't forget, stocks and bonds are just a very young concept. They only started at the start of the 20th century, and we have now a developed stock market in this country. Other parts of the world don't really have as developed a market. And as a result, synthesizing products or developing products that solve or meet customer solutions, and then hedging out the risks of the production of these products by entering the markets, is something that investment banks are doing now for corporations and other entities around the world, and will continue to do so as the costs to do this fall or are much lower relative to the cost of competing alternatives. And this is where the growth is. It's really reducing through financial acumen and financial technology and computing and communications technology to reduce the costs of meeting client needs. And the successful firms who do that will obviously profit and reduce the cost of capital for society as a whole, and everyone's going to be better off.
I see people taking notes. All right, I want to ask you something. Tell me if you'll tell me the truth. If not, just don't give me an answer. But what do you wake up worried about in terms of the future of the financial markets, the global financial system, the U.S. markets, and so forth? What do you think is the potential pitfall that you see on the horizon, and what do you worry about, and how worried are you?
Me?
Yes, you will. I got you on a roll. Will you share that?
Well, no, actually, I think that one of the biggest problems we have around the world is crisis management. All the risk management systems that are in place are terrific when it comes to continuous movements and the abilities to, say, delta hedge or small changes in things. The fundamental issue is confronting all financial service firms around the world is how do you handle a crisis? In a sense, if you have naivete in how you manage your financial affairs, as some of the banks did in Southeast Asia, or some of the individual corporations and entities did in Southeast Asia, and then all of a sudden you have a downtick and they're highly leveraged with mismatched assets, and you invest in very illiquid securities, that worries me, because it means that you're just sitting there with a sword over your head and you're gambling, essentially, that nothing's going to go wrong or there's going to be no perturbations. And so essentially in a society, if there's self-interest, one would build systems to protect yourself in a crisis. And I think that with the technology we have and the globalization of the world, it is globalization of corporate activities and investor activities now, that it's very important for all of us to realize that we have to be smart in how we think about planning our capital structures, how we think about planning for financial crisis. And we take for granted sometimes that everyone understands all these tools. And, you know, I've been in the education business for a long time, in addition to currently in the investment business, and people used to pay me to educate them. So I do think there is a great responsibility, if you have clients that are around the world, to make sure that they at least understand, just as those clearing firms did here in 1973. They wanted their people to survive because there was a franchise. And the franchise is providing services, not gambling necessarily on the direction of markets.
That's interesting. Well, I have to move down to the end of the row. Billy, talking about creating systems to deal with a crisis. Please don't just give me, you know, circuit breakers.
No, I wouldn't give you circuit breakers. I thought I'm sitting here working on things that keep me awake at night.
Okay, well, what does? And I think that's got to be one of the issues.
I've got two things that keep me awake at night, one of which is Y2K, which you mentioned earlier in your opening remarks to this second session of this period. And as you well know, we are the designated enforcement agent for the 400-member firms that do some business at the New York Stock Exchange. My concern is less, perhaps blasé, perhaps, but less regarding the United States, but what happens around the world on December 31st, 1999 as you move with the sun. So I throw that out as one thing that bothers me and troubles me. The other would be, if you will, that the CBOE and the NYSE are the two largest floor-based markets, if you will, in their respective products. Can we continue to provide the liquidity that our customers demand? Can we continue to provide the technology that will allow people to interact in those markets? And of course, then the old great bugaboo is there a Bill Gates out there that is going to find something that puts us all out of business?
Is there?
Always that possibility, Terry.
That's interesting. Okay, those are things that keep you up at night. Phil, global, institutional, and you know, a lot of derivatives, I think, on your books, not necessarily exchange-listed ones, but corporate kinds of banking transactions. But what is the pitfall that lurks?
Well, I kind of agree with the combination of what Dr. Scholes and Billy said. If you ask what keeps me awake at night, it is the global interdependence of what's been created, and it's only been able to be created because of technology. And whereas if you take a specific like YK 2000, everybody's very worried about it. Our sense in all the research we've done in the United States is that people are worried about it, addressing it, and really getting after it, and maybe some smaller players won't get there. But it's not a systemic problem. We don't get the same feeling when we go global and do research in Latin America and Asia, where the problem isn't viewed with the same urgency, and yet if you want to lay awake at night, we are no longer, you know, insular U.S. We can't count on our SEC or our NYSE to protect the system. And so I lay awake at night worrying about what happens outside of our control, outside of our system, since we're all dependent. And that would truly qualify as crisis management from Myron Scholes. So I would put that as my number one worry, and it can be, you know, the conversion to EMU could be it. It could be YK 2000. It could be, you know, any of the next events. But it's this interdependence. It's never been tested. It's just never been stressed. So
Jim's nodding. I think he's worried about a power outage, a brownout. I mean, if all, seriously now, just ask, is that one? That must be one of your things. I mean, everything is online. Markets used to go on when the traders could be on the floor, although we have some power outages here every once in a while. But your whole business depends on that plug, you know, the electricity coming through the outlet.
That would be true, and that would also be why we have a whole host of diesel generators, just in case.
Where are they? I mean, no, I bet we better, never mind. No, sorry, I asked, take that back. You have a host of diesel generators, just in case.
Oh, absolutely. We actually had an opportunity to use them during the earthquake back in 1989. Schwab Building was actually the only building in downtown San Francisco that had any lights on. And it is, I guess my concerns are mostly centered around technology. I guess speaking from a sense of immediacy, this is an interesting environment for our firm and for many other firms. It's essentially a declining sort of revenue per unit environment. Prices have dropped rather dramatically quickly. I think the costs associated with running a business haven't dropped as quickly. Firms are feeling compelled to invest in their infrastructure, build their technology systems. They must in order to maintain their margins. And there's some fear associated with that. I think we've all had projects that have gotten away from us on the technology side. And technology is changing so rapidly. You know, we don't want to have to go through these sort of reinstalls every 2 or 3 years. So we need to make sure that these systems are flexible and scalable. And that's kind of the watchword, I think, for us going forward.
Interesting thing to worry about. I'm going to ask Ken, who already mentioned a bit of his worries, but if any of you have questions, there are microphones in both aisles, right across from the cameraman, as a matter of fact, over here. So if you'd like to come up to the podium. And let me just, you did mention the responsibility of running mutual funds with real people, real investors who are not necessarily so astute.
I continue to be concerned that so much has gone into professionally managed mutual funds, for instance, during a period that historically may not be realistic. And I think there are many, many individuals, and you've seen studies and surveys of people's expectations for that investment, and in many cases people are expecting annual returns in the stock market of anywhere from 18 to 30%, and I've seen surveys even higher. And anyone that's been around in the business knows that that's unlikely to happen. And I think people who are betting their retirement funds, blindly putting money into the market, trusting individual portfolio managers who are paid like NBA basketball players today, I think there are some potential risks associated with that. That to me, I put that right up there with the risk of technology and kind of the mechanical risk of the system.
Okay. Are there anybody at the mic? Come on now, does that mean you think I'm doing a good enough job that I can ask all the questions? Here comes someone over here to the microphone. Would you just say, do you mind if, who you are and then state your question?
Sure. My name is Paul Barr, and I'm a reporter for Pensions and Investments magazine. I'm just, I guess this question would be for everyone. I'm wondering if you'd expect the SIBO or any of the major U.S. exchanges to switch to an electronic platform in the next 3 to 5 years?
Brodsky, you're in the front row. There's another microphone. Is this a no comment to the press? See, I have dual roles here. I always like to make sure the press gets answered.
This is supposed to be a celebration.
I thank you for that question. I agree with what Bill Johnson said, and that is that those of us who run floor-based markets, and we run the biggest floor-based markets of our respective product groups, have really an obligation to the system that we have and the liquidity that it provides to continue to automate that which we have so that we can continue to do the things we do best, but provide the Schwabs and the Morgan Stanleys and the Liberties, etc., with the order entry, the efficiency, the cost savings that they deserve and demand, but also provide the liquidity that has still been produced in open outcry markets that far exceed the liquidity in screen-based systems. But we recognize that the march of the technology by screen-based systems is going to go on no matter what we do. So we have to constantly be working harder. And I think we can do it, but we have to work a lot harder this year than we did 5 years ago.
Okay, don't leave. Don't leave. You're doing a great job. Please come back. I might need you. Any other questions out there? You know, this one comes to my mind. You're not exactly, or no, none of you is exactly a banker, and yet you may be by our new definition of what a banker is. So what do you think, I'm going to start with you, Phil, but what do you think about what's going on in evading Glass-Steagall and bringing down the walls that have traditionally been set up? I mean, you set part of that in motion in terms of size, but what do you think about cross-product types of mergers?
Well, I think again, full disclosure, myself and my firm have been advocating the demise of Glass-Steagall in Washington for 12 years consistently, even though we were only a securities firm and understood that allowed banks to come into the securities business, because the regulatory structure that we have set up in the United States will not work for the next 20 years. Europe is far ahead of us in terms of getting a regulatory structure that recognizes the kinds of innovations and the changes that have taken place both in banking and in investment banking and in trading. And so we're taking one of America's competitive advantaged industries and disadvantaging it by regulation. And I think that's far more important than any individual firm's point of view as to whether they want more competition in the United States. So we're solidly in favor of the demise of Glass-Steagall and the adoption of a new regulatory structure that makes sense and regulates by function rather than by what used to be industry definitions that don't exist anymore. And so to me, if you take something like the Travelers, Smith Barney, Citicorp merger, which under any common sense definition clearly violates Glass-Steagall and many of the other old laws, I'm in favor of it. I hope it happens, and I hope it gets Congress to get off their backside and pass some restructuring legislation that makes sense for everybody, gets us closer to what the markets are today and what they ought to be, and carefully regulates us, but lets us go out and compete and the best person win, regardless of whether they're a bank, an insurance company, a mutual fund company, or a securities firm.
I'm glad you led us in that direction, which is far safer than asking you all for market forecasts. Let me lead you into politics, which you've done for us. Because the regulators and the politicians do really have their hand at the throttle or brake lever for this financial services revolution. What's needed to happen both in Washington in the regulatory environment? I think actually Arthur Levitt was very encouraging this morning from my point of view, but the politicians are going to treat this, and have for the last number of years, as as an open briefcase kind of an issue. Is there any sense that without getting involved in antitrust issues, that you all can get together and impress on Washington the need for this kind of freedom of regulation, from regulation?
Well, it's very difficult for the industry to get one industry, as Mark Lackritz is sitting there laughing, SIA, it's very difficult to get one industry together to take a single position, much less 4 or 5. So I think while everybody will try, that is an unlikely way for all of this to evolve. Unfortunately, I think it's like so much of politics. Events are going to drive it. I think the Travelers Citicorp might drive it. Might wake everybody up to say, hey, it's already here, it's already done, maybe now we ought to pass a law that recognizes what is going on in the marketplace. So I think that events are more likely, or if we start losing market share seriously to Europe, and Arthur Levitt was very sensitive to the point, what's happening? Firms are moving OTC derivative action outside of the United States, and it's happening every day. And I think economics finally do have an impact on the political process, and we'll try to bring some of that back. So I think events are going to drive it rather than wisdom. The 12 years I've politicked these issues in Washington, trying to take an enlightened position, convince me wisdom won't win.
All right, let's wind it up with Professor Scholes, a man who was there at the beginning looking forward. Give us your global perspective now, please, just briefly, because lunch is about to be served. Give us the last word on the global perspective for the financial markets. Where's it going?
Well, I have sort of stated it before, but in terms of one of the nice things about a celebration, a 25th anniversary, is that you want to not dwell on pathologies. You'd like to deal with physiology, you know, and
that's why I called on you for this.
Right. So I think what's happening has been stated is that as the world has become smaller, and what we've done is it's forced us to think along the idea of a client-oriented focus and not as a product focus. And the way our institutions were organized in the past was on product focus. You had insurance, or you had brokerage services or mutual funds, or whatever it was. It was in products. And I think one of the great things that's happening, and what is this evolution away from that to providing financial services to individuals, to corporations, to even government is going to have to learn the new technologies. I mean, it's very fascinating to me that the Philippines, in trying to decide on showing that they weren't going to devalue the peso, actually had issued put bonds, which are natural providers of insurance against devaluation. So why is it not that the regulators themselves are going to, by necessity, lose the degrees of freedom that they had, because as the frictions are reduced and we have more of a global environment, that the amount of that you have to take an endogenous perspective and not an exogenous perspective. The regulators can't make rules exogenously from what is happening in the marketplace. So my great joy is going to be to see that we're going to see many more new innovations, going to see many more ways in which investors are going to be satisfied, corporate entities are going to be satisfied in a much more productive way. And for me, I think contingent claims, options, and nonlinear payoffs are going to be a large part of that particular growth. And it's going to be exciting. I think we're just embryonic now. I mean, it's just amazing. I was very surprised to know that the top 8 banks in the United States have 94% of the over-the-counter derivatives now in the United States, which at the end of 1995, which is amazing how much more growth there has to be among entities around the world.
So we're at the start.
Yeah, we're at the start.
End. This is very exciting. 25 years ago, we all did gather in the smoking lounge of the Board of Trade and launched something that was so very, very exciting. We thank you all for participating in this symposium and for giving us so much to look forward to in the next 25 years. I thank all of our panelists, and I will turn it back over to Wayne.
Terry and gentlemen, Bill Brodsky and I have been sitting here overwhelmed by the remarkable quality of what we've just witnessed. We thank you very much. Please, everyone, one more time. And Bill wanted to make sure I mentioned to you that we'll have a commemorative print of the options floor for each and every one of you. Thank you. It's now time for lunch. Our march to midnight, as I said this morning, continues. Mindful of the schedule of our luncheon speaker, I'd ask each of you to make your way about 100 feet down the corridor here out the door to the grand ballroom as promptly as possible. We'll see you down there in just a few minutes for lunch and for Secretary Rubin's remarks. Thank you all.
Financial history notes with no small amount of irony that the first chairman of the SEC was a notorious stock speculator, Joseph P. Kennedy. Summoned to Washington by Franklin Delano Roosevelt to curb the very manipulations of which he had been accused, Kennedy used his understanding of market behavior that he had gained as a speculator and worked zealously to make the market safe for all participants. Over the next 60 years, many followed Kennedy's footsteps as chairman of the SEC, but few, if any, had his insight into the way of the markets and the investment industry that had grown up around them. That was until 1993, when Arthur Levitt Jr. was sworn in as the 25th commissioner of the SEC. Now, I must be careful to point out that unlike his predecessor, Arthur's market insight was not the result of notorious speculation. Rather, it was the byproduct of a 27-year career on Wall Street that included his chairmanship of the Amex from 1978 to 1989 and his leadership at Shearson, now part of one of the firms poised to become a component of Citigroup. It was at the Amex that I got to know Arthur and worked under him for 4 years while the Amex built, among other things, the options market. I learned that if he were notorious for anything, it was for his leadership and his intelligence. He developed these with the knowledge of the way things really work on Wall Street. And he has since established 4 priorities at the SEC: improving investor protection, reforming the municipal debt markets, raising the standards of practice for brokers, and strengthening the prominence of U.S. capital markets the world over. During his term as chairman, the SEC has established the Office of Investor Education and has created one of the most popular sites on the World Wide Web through which the public receives corporate filings free of charge. Under Arthur's leadership, the SEC has worked to sever ties between the political campaign contributions and the municipal underwriting business. And the SEC has raised the industry's sales practice standards by attacking conflicts of interest in broker compensation. Armed with first-hand knowledge of the benefits of options, he has also been a force for eliminating the bureaucratic obstacles to introducing new products and implementing rule changes that thwarted the growth of the options market. Just a few weeks ago, Arthur was nominated by the President to serve a second 5-year term, the first chairman of the SEC in history selected to do so. I believe his effectiveness has everything to do with the respect that we have for what he knows. And agree or not, when Arthur speaks, we listen. Ladies and gentlemen, the chairman of the Securities Exchange Commission, Arthur Levitt.
Thank you very, very much, Bill. This is really a sentimental journey for me. So many of you interface with my past, and probably no one more leaders and participants on the exchanges. Your role in maintaining and nurturing the public perception of fairness and efficiency in our markets is critical. Education is critical. But confidence also comes from the belief that exchanges are governed and operated in the public interest, an interest that goes beyond those important people on the floor, those important people on the staff, those important people on the boards. Designation as a self-regulatory organization carries huge responsibilities. I can think of no better way to ensure fulfillment of those responsibilities than to have a substantial public representation on the board of every exchange. And that's why today I ask for your help in developing a more balanced board of directors. Reaching the right balance must be the hallmark of our efforts, both for market participants and for regulators. We must always remember that we have a duty to uphold the public interest. Looking to the future, responsible regulation, I believe, requires flexibility. As your business modernizes, the Commission commits to modernize our approach to regulation as well. We must pursue approaches that are adaptable to the continuing explosion of technological capacity and to innovative development of new derivatives products. To help meet that challenge, the Commission, just last Thursday, considered a pair of deregulatory proposals that are designed to help you be more nimble. We believe that these proposals will help you compete better with new trading systems, overseas exchanges, and the over-the-counter derivatives market. The Commission is proposing to allow exchanges to operate low-volume trading systems and to trade most new products without first receiving commission approval. Under this approach, you would be able to experiment with new trading systems for up to 2 years. And more than 90% of all your new products would be able to go to market without any delay. That's a revolution. That's not evolution. I think this will put more pressure on the SEC to conduct thorough inspections of the exchanges, but it would free you from the often time-consuming pre-review process. The proposals underscore our commitment to enhancing the competitive aspect of U.S. exchanges without sacrificing investor protection. I so clearly remember when I was at the Amex, the frustration we felt as we waited what seemed like an endless period of time for the bureaucratic process to run its course before we began trading new products or starting new systems. The Options Clearing Corporation. It's the largest and most trusted clearing organization in the world for financial derivatives. When one thinks about or talks about systemic risk, there is a general recognition of the fundamental importance, the essential importance of our clearing operation. And certainly the OCC has done a simply wonderful job in that regard and has earned the trust of the public it protects. Of course, the success of the options market hasn't always represented a totally smooth ride. And I can recall frenzied calls from my predecessors, one when I was at the stock exchange by Harold Williams, urging me not to put on any new contracts to go into the then notorious moratorium. And there's been a constant ebb and flow and political and business tension as we move forward. After the market break of '87, many investors soured on options and volume dropped precipitously. At that pivotal moment, the options exchanges recognized that they simply had to restore investors' confidence in their products in order to survive. Because after all, in options, as in all business, trust is more easily won than lost. And I think those leaders of option markets have been so astute in recognizing the importance of teaching the public, of educating them, of telling them how to ask the tough questions. Because a public that is informed is in so much better position to move forward and to understand and to propel the growth of something as innovative as and as important as the options business in the world today. So the U.S. options exchanges began collaborating through the Options Industry Council. Its educational campaign focusing on teaching the responsible use of options strategy to retail users has certainly helped establish investor confidence. While this effort has been a great success, we've got to do a lot more to educate the public about sophisticated financial instruments. There's been a lot of misinformation out there. There's been a lot of fear about some of the new products. There's even been an effort on the part of the Congress going back some years to regulate or do away with some of those new products, and that would be, in my judgment, a national economic tragedy. Education is the cornerstone of what we have to do to protect the franchise we have won so painfully. Working together, we have a collective responsibility to help investors understand the risks they might face, as well as the rewards they may enjoy. I think this is especially true since so many millions are novices, millions of investors who haven't seen a down market in 14 years, and that represents a special responsibility. As then Leo Pomerantz, I wonder if he remembers going back about, more than 20 years ago when I was at a firm that was then called CBWL, and Leo tried to persuade me that we should be in the options business, and I was too dumb to listen. But we learned by our mistakes. This is a wonderful occasion. every one of you are important participants in something which has made our markets the glory of the world, and I think it's time to take stock and to celebrate entrepreneurship and the enormous attainments that these institutions have created over the past 25 years. We've certainly come a long way since the CBOE opened up for business 25 years ago in a small and windowless room, the converted smoking lounge at the Chicago Board of Trade. I've always felt there's something about windowless rooms that gets people to focus in very special ways. In 1973, the CBOE's founders played a role like the one that the Wright brothers did in 1903. They started out with an old technology. After all, they were bicycle builders from Dayton, Ohio. But the Wright brothers took the theory of flight and they pushed it further. They hardly could have predicted during their brief flight at Kitty Hawk that they were opening the way toward the future, toward jet aircraft, transcontinental travel, and voyages to the moon. Like the Wright brothers, the CBOE's founders took a theoretical, academic principle and they put it into practice. And now the fortunes of millions of investors enjoy huge new opportunities for growth. Since those very first days of trading in the spring of 1973, your volume has grown phenomenally. It's gone from just 911 contracts on your first day for call options only to about 700,000 daily contracts for puts and calls today. This celebration that we're all part of recognizes much more than your quarter of a century of effort on behalf of investors. These events are also, in a sense, a celebration of what works, especially when the financial community's spirit of innovation is left free to act with a minimum of interference. Your success has shown that the entrepreneurial drive is limitless and that the role of regulation indeed should be limited. It's no secret that when the options business started, most people at the SEC were critical, and as you know, some were even hostile. Your innovations provoked a lot of honest debate among people of very goodwill on both sides of the issue. The easy path certainly would have been to stick with the status quo, to dig our heels in and not to change the old rules. But I think my predecessors at the Commission ultimately made the important decision to embrace change. We made the right decision. Your innovative ideas about trading were a challenge to regulators. The Commission was confronted by new types of securities and new methods of allocating risk, and that compelled us to alter our thinking. Certainly, it wasn't easy to change. It seldom is in business, in government, or for that matter, in any aspect of society. When the SEC was thinking through the question of what to do about options trading, the Commission was reminded of a truth that's simple in theory, but hard to put into practice. Regulation must always be strong enough to serve the public's needs, yet it must never become so tough that it chokes off innovation. A changing marketplace cannot be governed by restrictions that stifle its fundamental agility. The Commission, I think, eventually reached a balanced judgment when it considered the question of options in the 70s. We did a careful study of the new options market, and we decided that the naysayers were simply wrong. We recognized that the potential of options could be unleashed if it was coupled with a sound and tailored regulatory approach. I think that's an awfully wise approach to apply to all of our regulatory efforts as we move into the 21st century. Because the SEC in the early 70s ultimately had the wisdom to allow our markets to innovate, options have today become a viable choice for investors in managing risk and in allocating capital. Last year, the number of options on all 4 major exchanges increased to nearly 280 million contracts, up an astonishing 40% in a single year. Each of our options markets has contributed to that growth. The CBOE is the contract volume leader and certainly one of the chief innovators, creating products such as leaps and flex options. Amex took its in-house derivatives expertise and developed popular equity derivatives such as spiders and equity-linked notes. Philadelphia is the pioneer in currency option trading and has been recognized for developing a number of successful sector index products. The Pacific has seen impressive growth in its equity options business, becoming a leading market maker for options overlying many important Silicon Valley companies. And the indispensable foundation for these exchanges